Let's see. Do you see start broadcast somewhere?
Start, show my screen. No.
Are we started? Did we start already?
I don't know. Maybe we started. Yeah. Can we have a confirmation?
That would be funny. Oh, that's funny.
I don't think so.
I think
Guys,
they hear you. So it started already. That's funny.
Okay, thank you, because we are okay. We didn't know. Thank you,
We
thank
didn't
you.
know that. Let me click on the start record button at least. They changed this view of the menu, so that's why I wasn't aware that you could hear us. But anyhow, let's start. Welcome everyone to our live webinar here at Admiral Markets regarding intra-week and volume strategy. So glad that you could join us here on the 13th of June 2013. My name is Chris Forsek.
And my name is Nenad Kerkes, known as Tarantula on other forums. Welcome, guys, and here we will show you how to use volume and intra-week strategies.
Alrighty, we're looking forward to that. And as you know, this webinar is hosted by Admiral Markets. So thank you, Admiral Markets, for this great webinar. And before we actually continue, I just want to show you one website I think is very interesting. Take a look at this. First of all, no, that's not what I wanted to show you. Yeah, here, this market analysis website here. You'll see a lot of cool stuff regarding Forex, such as central rates, but also bulls and bears, and today's calendar as well. And if you're not aware of that, by the way, here you can see the current spreads at Admiral Markets. For example, euro dollar 0.7, but also the Aussie dollar 1.2 or the CAD 0.8. Any of these you can see right there, very low as you can see. All right. So let's start the webinar. Just as always, before we do that, the risk disclaimer. Please be aware that trading foreign exchange on margin carries a high level of risk. Just like any global financial markets, please be aware of that and seek the advice of an independent financial advisor. And this video and webinar is for educational purposes only. So we thank you for your attention on that. And today's goal, we're going to take a look at, as we said, these intra-week and volume strategies. And Tarantula is going to kick it off with looking at these volume strategies.
Yeah, volume strategies. Yeah, but let's make sure that we are not talking about actual volumes. As you already know, that is my principle, and those are my teachings that I always teach and tell to traders. There are no volumes. So when we are talking about volume strategies and volume spread analysis, that's another thing. We are talking about ticks. So Forex is not centralized market. It does not have a central opposing to stock markets and futures. So we are talking about ticks. So where I would say in future in webinars volumes, it means ticks. So let's talk about volume spread analysis, defining volume spread analysis, why volume strategy can be good. So we will talk a little bit about it. Chris, do you have anything to add? Do you agree with me about Forex volumes and ticks?
Yeah, definitely, indeed. Personally, it's not something that I really incorporate into my trading, so I'm very curious. I'm looking forward to your presentation on this, actually.
Yeah, so I don't incorporate those that kind of strategy, but it is useful from time to time to watch because I will show you it's a completely different strategy from what we've been talking about these last couple of months, because basically we are using market strength, and that's pretty interesting. I will show you how you can trade it. So we will talk about defining volume spread analysis and why volume strategy can be good. Show us the next slide, please. So yeah, here again, breakout, volume strategies, price trends, and volume spikes. Those are all different kind of strategies that we use in a volume spread analysis. Those kind of trading strategies. So we were talking about a price action, And now this is a little bit different. You will see why it is different, because it indeed uses one indicator, and that indicator you can Google it. You can Google it for any volume spread analysis indicator for MT4 platform, and it is pretty straightforward to use. But it's good that if you have listened to our previous webinars, because these kind of strategies use support and resistance levels, use supply and demand zones, and also use trend and trend lines. I will give you a brief introduction to volume spread analysis, and if you are interested, because it's a really wide subject, you can Google it and you can find it a lot of good infos, especially on Forex Factory. There was a guy called Malcolm B, and there are many guys who use this strategy to a professional level. So I'm telling you, I'm not a professional in this strategy. I know what it is, and I know how traders use it. But if you want to find a deeper introduction into volume spread analysis, you can Google it. I recommend searching the Forex Factory forums for specifically from volume spread analysis trading systems. I will tell you about a brief introduction, how you can trade breakouts, how we trade price action, and how we trade counter trends. So it's a pretty straightforward. So maybe with some little practice, small practice, you can use this what I show you also, because this is, I like to keep it simple. You know, my quote is keep it simple, stupid. So this is really simple, stupid. Defining volume spread analysis. Yeah, we need now to talk what is actually volume spread analysis. It's all written on next slide, and it really says the first thing and the main thing in Forex, volume does not exist, because there is no central place of the market to measure how many transactions has been taken. When we talk about volume spread analysis, we refer to tick volume. Volume spread analysis is the study of the market forces of supply and demand, and the manipulation of those forces through the psychology of crowd behavior. This may sound a little bit you know, hard to understand, but you will see this kind of strategy is really straightforward. So volume spread in the final analysis, it's very important to know VSA uses three components on the chart to determine the balance of supply and demand, as well as the probable near-term direction of the market. So it will give us precisely where to enter, where to exit. It won't give us an arrow signal, of course. It's not that kind of I guess stupid. It's not. It's a good thing. As you can see, the volume exactly as an indicator, and we use it if it's very close to a support or resistance or supply or demand zone. So these components are the amount of volume affecting the price spread or range of the price, and where the price closes. It means that it is strongly linked to price action. But we don't use candlesticks, we don't use stochastics, we don't use anything besides that volume spread analysis indicator. So we can study the market psychology and forces when we trade the strategy. So when do we use it? Always in periods of consolidation. So we don't use this kind of strategy when there is a huge move. Only in the period of consolidation, or when we exploit breakouts. I will show you how to exploit breakouts with volume spread analysis, VSA. So when supply and demand are in equilibrium and trending periods, and when the market is in a phase of accumulation or distribution, and the forces of supply and demand are out of balance, that's when we use this kind of strategy. We need to get the price to equilibrium level. And equilibrium means if the price is too high, we sell it. If the price is too low, we buy it. It needs to be in equilibrium. And if you remember my analysis from today, you know, guys, Many people told me that they long the euro, especially long heavily euro USD today. But this is, you know, this is where VSA kicks in. I didn't use VSA kicks in, VSA especially today. I just used a price action. But I saw VSA today. It was a very good indication that the prices will turn from the resistance. Because why? Because prices need to be in equilibrium. We cannot always have a big trend. We had a big trend, and now it was time to retrace. There is a pair which a little bit confuses me, and that pair is, of course, cable. Because on my analysis, cable should have dropped to today to 56.30 at least, but it didn't. Basically, what it was, a euro tanked down, and cable was really going up hard. I didn't see the last couple of hours, but I know that it was really hard to go down. So it will eventually go down, but this is where we use volume spread analysis. We need to see psychology of the market, and we need to get the price to equilibrium. That means selling into resistance and buying into supports. And we need to drive the price into consolidation zone before accumulation and before distribution exactly. If you know market cycles, distribution is where the prices are manipulated. They are manipulated by all of us, by speculators, by big banks, by hedge funds. They are manipulated by central banks. You know that when you see a huge spike in the price, what it means after the news, it means that the price will eventually go down, but they are manipulated, and especially before the news. If you watch, for example, cable today, I had some trades with cable today. It was 50-50, but at last it was final trade was very good, and I saw that the price is being manipulated to the upside. When the news, USD news came, price went down to test support, and that is where we kick in the spike, and we fade in that spike. That is what VSA does. It waits for the spike, and then we go in contra direction. I will show you that later on practical examples. So why VSA can be good? Why VSA, especially the indicator about volume spread analysis, can be good? So the first thing is VSA teaches that strength in the market is shown on down bars and weakness is shown on up bars, contrary to major of indicators. VSA indicators teaches that strength, this is very important to remember. When we have down bars, we have strength in market, and we have up bars, we have weakness in the market. And that is exactly the opposite of what most traders think they know as the truth of the market. Why? Because you don't want to be in the herd. You know, you follow the price, but you don't follow the herd. Herd, you know, is usually 90% of them are wrong, and you don't want to be wrong. You want to trade with big banks. You want to trade with hedge funds. You want to follow the real price. You don't want to follow fake outs. And that is usually where we lose our money. Fake outs, fake spikes to the upside and downside, fake breaks of support and resistance. So we need to see, and we need to see where the real price is going, and VSA can help us. Now, it doesn't mean that I purely use this. From time to time, I get my eyes on VSA. But what I do, I know all that in price action, but it's another team. Now, you know, when you have 4 or 5 years of experience in the market and you watch it every day, you can feel it. But especially for kind of traders that cannot trade every day, each day, and they're very busy, they can use this really to their advantage. And now I will tell you also one secret. For a true downtrend to occur, there must be a lack of substantial buying demand to support the price. That is for a true downtrend. It doesn't mean downtrend on 15 minutes time frame. Why? Because professional traders don't use 15 minutes to analyze the market. They use 4 hours for intraday or intra-week. They use 1 hour, and 5 and 15 minutes are for entries if they trade by charts. And I'm not talking about all professional traders. They use different platforms, they use different time frames. But most of those that I personally know of don't trade the price purely on high or low time frames. They analyze the price on higher time frames, and for entries they zoom into lower time frame, and then that is called multiple time frame analysis, and that will be a subject in our future webinars. So that is how I personally do it. VSA can help us to, if you don't want to analyze a whole time frame starting from top to bottom, we can use this purely indicator. So the only traders that can provide this level of buying are the professional operators. That is what I'm telling you. But they have sold at higher price levels earlier on the chart during the distribution phase of the market. So that is the secret, guys. This is real thing. This is not, you know, there are a lot of $97 systems on internet. You can Google it every day, each day. They're earning money with those fake systems. Indicator cannot give you an exact entry time. The earliest entry you can have it is by divergence. This is what I do. And volume spread analysis and volume strategy gives us that precise entry if we don't want to follow the divergence. Just by analyzing the tick volume of the platform and of the real buyers and sellers. The professional selling is shown on the price chart during up bars with volume spike. And then when we spot weakness, then we see that the price will turn. That is not fake, that is real. So we have a breakout in any direction, and then after the breakout, if we see a VSA spike, we presume that the price will turn. Since there is very little buying, the market continues to fall until the markdown phase is over. Markdown phase, it goes just after the distribution. You know the phases of the market. So after the markdown, the market continues to fall. The professional operator buys into the selling. Now listen to this. Professional operator means professional trader, professional hedge fund trader, professional. He buys into the selling. This is very important, contrary to most of us. He buys into the selling. It's called fade out, fading into the weakness or fading into the strength. That is almost always created by the release of bad news. This bad news will encourage the mass public, herd, to sell, almost always for a loss. The professional buying happens on down bars. This is also where VSA can help you. When you see spikes, we will show you that in later pictures and slides. You can presume that the price will turn, but you also need to watch the news. And that is what most of traders ask me, how it is that there were good news for euro or for dollar and the price goes in opposite direction. That is the thing, because there are a lot of manipulations in the market, and if we follow the manipulations we will lose. We need to follow the real money, and the real money is created by big money. We retail traders can move a price a bit, but believe me, there is no stronger player than central banks, than big banks like ECB, like Fed, like Bank of Japan, of Australia. Those are huge buyers and sellers, and huge manipulators. If they want to sell euro today, they could sell it for 500-600,000 pips if they want to. But that would be unprofessional, and that would be a really bad form. But that is another story now for a lot of economies. But we need to see just where the professional money goes, where the real money goes, not where herd goes, where real money goes. So that is why volume strategy is good. That's why VSA is good. Now this is the first example. We'll talk about breakouts and using VSA to help in breakouts. Now we can show next slide, Chris. So I'm telling you again, you can show us the whole example and I will talk about it. The whole example of this slide. And I'm telling you again, if you want to see a deeper trading strategies using VSA, just Google it or use Forex Factory. There are a lot of good trades concerning VSA. So first thing, breakouts. You can also practice with this kind of strategy, because I personally don't trade purely by VSA, but I throw my eyes from time to time to see if there is a fake buying to confirm my thoughts, or there is a fake selling to also confirm my thoughts. So traders will often look for breaks of support and resistance to enter positions. There are two key components to confirm a breakout. It's the price and the volume. Again, it's a tick volume. It's not a volume, because Forex is not central. It's a tick volume. So when a pair breaks critical levels without volume, we should all consider the breakout to be suspect. We are not sure that that is a real breakout. So volume breakout is characterized by a volume spike that towers above the preceding few bars worth of volume. So we have a volume breakout, and that is what indicator shows. Most time we can visually spot, we can visually spot what the average volume will look like and compare it to the volume breakout spike. So in consolidation phase, we can see how those bars look like, and if that bar turns immediately to the upside or downside, or something is happening around the support or resistance, we can try to imagine that that might be a fake out. And we need to see, we also need to watch the news, because those breakouts are not, how can I say, classical breakouts of support and resistance levels. For example, what I also teach, breakout pullback continuation, or a retest of previous level, or those kind of breakouts are mostly exploited in the news time, because in the news time there are a lot of fake movements. We don't see a lot of fake movements. For example, today on Euro USD, it was a perfect downtrend, and we didn't see a lot of fake movements. We see that the price is zigzagging. Zigzag pattern is a trend pattern. 1, 2, 3, that is trend. So that is a perfect trend today on Euro USD. Cable had a lot of fake outs today, especially when USD news came in. It was 2:30. 2:30. You can watch your charts later. 2:30 Central European time. There was a fake buying to the upside, and after that it was some selling, something around 40 pips to downside. So that is where this kind of breakout VSA can help us. So volume breakout is a volume spike in a bar that is above average, and that is heavy volume. We will see that on later example on a chart. So Chris, move on, please. Yeah, that's it. You can show all slides so I can explain what is happening basically on the chart. You can click to show next, so we can see the marked, yeah, like this. You go with all of those kind of. So this is the first breakout signal. So this is the first breakout signal. You see the series of red downside bars, and this green level you know all that. This is a resistance zone. So this is where volume VSA kicks in. So it goes through a resistance, and we may think, wow, now we will buy. Now we will buy. But just watch after, just prior to that. What happened prior to that? You see those very, very big volume spikes. They are not in correlation with previous buyers, because it was just below the resistance, and we don't want to long into resistance, right? We want to see if that resistance will hold and presumably sell into resistance. And then we see a huge, huge spike. And we see that that bar is also giving us a false breakout probably. Because after that we see a red bars. We see that the bar structure is changing. Chris, can you please, because this slide is presumed to work like this. Yeah. And the second breakout signal, you see, there is a series of red downside bars. We see that it is in complete correlation with previous sellers. So you just watch this now. The volume on the first breakout signal is highlighted with a series of downside reddish histogram bars. You can see that on the chart. During that time, the price aimed to move higher than the key resistance level, and that is shown by our horizontal line. That is a key resistance level. So we want to use VSA close to key resistance or support levels. On the second breakout signal, the price fluctuated lower than the key resistance level, the price. But that is a confirmation that this time is a clear confirmation of a strong bearish movement. That green bar was a fake out. Because next couple of bars was giving us a signal to actually short into that spike, because it was series of green of red bars, but those bars they all made higher lows. If you can see that, all of those bars made higher lows consecutively, and you see those higher lows there. So this spike into resistance was a fake. How do we know that it is a fake? Just analyzing the indicator from down below, we can see that next couple of bars are pointing to the downside, and they are red. And after the level was retested, you see the retest there. We can also trade this as breakout, pullback, continuation, but this was a really false breakout. But you see on a retest, again, that was a fake signal. That was a huge, huge spike to the upside, giving us that signal that is probably a fake. So this is contrary to all that you know of those indicators. This indicator actually tells us that we should sell it after the green spike is a bit different from other spikes. So especially if that is close to resistance as this. So we can see that price actually follows the indicator, and after that it was really a strong bearish movement to the downside. So you watch for a first breakout signal. You see a green big spike to the upside, but that goes through resistance. If that continues to show green bars, that means that we are probably having a real breakout. So we wait for a pullback, then we enter. In this case, we wanted to see if this was a false breakout, and indeed this was a false breakout. We had a series of red downside, higher lows. So this is breakout. For indicator, you can leave on that chart, Chris. You can also try to look for VSA indicator. There are a lot of, you can Google it really. Also, look at this. We are again close to a resistance, and we can see that there is a price again spiking up into that resistance. So we want to see if that actually will confirm a breakout. Again, the price has not confirmed a breakout, and we should sell it. Why? Because on next couple of bars as you can see, 1, 2, 3. Look at the indicator. First is a very, very big bar to the upside. Then we had series of higher lows, and that is giving us a cue that this might be a real false spike to the upside. Now, the important thing is we use it only close to key support and key resistance levels. We don't use it on 1 hour supports, hourly pivot points. We need to see a real big resistance. I prefer 0 lines, 50, because 0 and 50 are levels where big banks are trading mostly. So the price tends to gravitate toward 0 and 50 levels. So 0, 50 levels, historical support and resistance, and we want to see the price for intraday trading close to 4-hour support or resistance, and then we can look for spikes. So that is about breakouts, false and real breakouts. This could have been a real breakout only if the price continued to print higher highs or blue, in this case, bars. But in this example, indicator showed us a big red bar, a big red, then a series of red bars. So that was indeed a false movement to the upside. And again, that is happening mostly on news time, not on a trending price action or when the day is a trending day. Now we will talk about price trends and volume strategy. I will show you what the trend is. You already know that. How to effectively use VSA when there is a trend. So Chris, you can show us next slide, please. So trend volume analysis is based on the free float concept developed by Gann, again by Gann. If you know, Marriott is also here, Marriott has its foundations in Gann principle. And that is applied in modern markets by Woods and Arp. So we won't talk about their teaching, we will keep it simple. So just a brief introduction. Trend volume analysis differs in that it uses the actual cumulative volume traded between significant trend points as a means of verifying future trend turning points. That is exactly the same what I was explaining in breakouts. So we want to see turning points, but this time we don't trade in a ranging market or in news momentum. We don't exploit news momentum. We exploit market momentum, that is trend momentum. This technique is mostly useful in identifying bottom reversals and continuation patterns in uptrends. So we want to see especially bottom reversals. So not as we use that breakout strategy close to support or resistance, but we want to see price trends in VSA close to support, mostly close to support, because by default equities are some like bearish driven. So we want to buy into a weakness. That is what it means, identifying bottom reversals. So we need to see big support and then false spike to the downside. Trend volume analysis is used as a guide, as we cannot be certain that the equities or the pairs, Forex pairs, which have changed hands, all belong to just one group of all holders. So, you know, markets are manipulated. There is not only one and only European Central Bank trading on the market. There are a lot of other banks, there are a lot of other companies, there are a lot of other professional hedge fund managers, pension funds, many traders, retail traders that manipulate the price. So it is best used to verify other trend change analysis. So we are talking about trend change. When the price is falling down, we want to see presumably a pattern, bullish reversal pattern, and then we use also this volume spread analysis to confirm that the price will indeed turn in an opposite direction. making a double bottom, triple bottom, or making a rounded bottom. So it's best used in falling markets, in bearish markets, where we want to see the uptrend. We can see that on next example. So this is again, this is an example of the chart. So we can see, Chris, can you just show us? This slide goes, you see, it prints out the arrows and so on. I will go step by step. We can see that this price, it's okay. Whatever this price is, it's having an uptrend. How do you know that it is uptrend? Again, but just by looking at the price. You don't see an indicator, you don't need an indicator to confirm that the price is uptrend. I always teach that you don't have to have any sort of indicator to confirm the trend. The trend is series of thrusts and pullbacks. In this example, it's higher, high, higher, low, higher, high, higher, low. We can draw a trend line, so this is where the arrow is. That can be a trend line over there. That is, you also can be moving average, dynamic levels of support and resistance. So this price is having an uptrend. Just draw a trend line. That is the most simplest thing. The overall trend, as shown in the chart, in an uptrend, even if there is a series of downside reddish histogram bars present, we see that there are a lot of decreases in a volume histogram. But this is an indication that the price has indeed weakened in momentum, but has no influence at all on the current direction of the trend. There are no huge spikes, as you can see that. The price is really, you see that all these bars are aligned. There are no huge spikes. So you can see that there are a couple of bars which spike out in a direction, and after that they are followed by red lower highs and red lower bars. So there is indeed the indication that the trend is still intact and that we can wait for a pullback to enter safely. So we can see that the price rises and the volume decreases. What does it mean? When the price going up and when VSA indicator is printing a series of red histograms, we prefer lower highs. That means that the uptrend is intact. And then we switch to another methods of finding the entry. You see, that is really simple strategy. Price is going up and volume decreases. There is a spike and then again it's dropped down. There is a spike in volume and then again it's dropped down. So when we see a big red spike, we want to see consecutive few bars. If few consecutive bars are printing out lower highs, we see that that is a time to search for another opportunity to go in trend direction. So the simplest thing is to remember, when the price is going up and the indicator is going down, we are ready to enter in a trend direction. So that is not hard. And next thing is that I will show you is volume spike strategy. There is another and the last kind of strategy to use with volume spread analysis. You will see what volume spike basically is. And this is again when we talk about VSA, that is very useful. It is useful especially in news-driven momentum. Remember what I'm telling you, momentum is not the same previous to news, prior to news, and after the news. Prior to news, we can have a ranging or trend momentum. That is very important, ranging or trend momentum. And when news spikes in, I'm talking about big red news. I don't talk about orange news, which are shown on Forex Factory or Forex Street. I'm telling you just about, and I'm talking about red news, so huge news. There is then, that is then when volume spike strategy kicks in. That is called news momentum. So it can be a totally opposite of totally following trend direction. So that doesn't have to do anything with intraday trading. That is purely for news-driven momentum. This volume spike will often lead to sharp reversals, since the moves are unsustainable due to imbalance of supply and demand. That is that unequilibrium, or inequilibrium, how it is said in English. But the thing is that we need to find the equilibrium again. The point of equilibrium is buying into support and selling into resistance to find a medium pivot point price. You know that pivot points are basically a median price where the price tends to consolidate, and pivot points are usually when we place new buys or new sells. That is clear to you. When there is imbalance of supply and demand, and there are a lot of trend movements, that means that there are a lot of spikes to the upside or trend moves without any retracements, called direct falls or direct rises. That is when we should see the opportunity for the price to find an equilibrium, and we want to take counter trend trades. Trading counter to volume spikes can be very profitable, but it requires enormous skill and mastery of volume analysis. This is the most helpful strategy in news trading strategies, because we exploit the news-driven momentum, especially on cable, especially on Euro USD, on dollar yen, or those major pairs. We don't want to see price going up and then spike in volume to go in that direction. If we have a spike in volume and that resistance is broken, we usually go in contrary, just close to that resistance. So we are selling that. The presence of a volume spike is nearly always the result of activities of institutional traders. This is what I was telling you a couple of minutes ago. Hedge funds, pension funds, investment banks. So they are all institutional traders. When these news data releases are released, there is often a surge in trading volume. And that doesn't have to do anything with prior trend. This is purely news-driven momentum. And traders weigh in on what the news will mean during a period of time. That is called consolidation after the news. But real traders which use VSA want to exploit that first spike to the upside or downside just because they will have an early entry. Early entries are the best entries you can ever have. I personally use divergence for early entries because I don't trade the news. Yes, okay. Chris, you can show us all on this chart. I will show guys and girls what that means. So we want to get as early as possible. So if we want to go in a news-driven momentum, we want to see volume spikes or retracements as we teach on NFA strategies. But it's most useful to enter on the first spike to the upside or to the downside, just because that is usually a false move. And if you lose, you won't lose much. You won't lose much because you are buying into support and selling into resistance. You won't lose much. If you sell into support, then that is the time where you can lose much. But if you buying into support, even if you lose, you won't lose much. So volume spike strategy, we see that the price has been consolidating above, let's say this is a pivot point. Let's say this is a pivot point. And the price is consolidating above the pivot point. The green histogram spike highlights the presence of a volume spike. So we see that there is a volume spike. It's marked on the chart, meaning a strong trend reversal. This trend reversal is also confirmed upon breaking the key support level shown by the horizontal green line. So this green line, let's call it pivot point, just for the sake of this presentation. Volume spike led to price rise. You see what happened. That is news-driven momentum. The trend is intact. So you won't be fooled into taking a short position. That is happening 70 or 80% of the time after the red news. This thing happened today on cable. You can just watch the cable prior to news and you can see on 1 hour what was happening. So the green histogram spike, we have that as a fake spike, and pivot point has been broken to the downside. But you can see that volume spike above that level mark on VSA indicator. When you Google for VSA indicator, you will usually have this level already on the chart. So you can see that this level, this pivot point has been broken. But you also see a big green spike. And what happened is after that you see that there is a red spike. That means that there is a false breakout. And what happened after that spike, and the red spike spiked the price to the upside. And then we can see again a series of lower highs and series of red histograms. That means that the price is not printing to the downside. That means that the price will continue to go upside, because you see there is, as you already know, there is a lack of substantial selling. That is only 1 bar of selling, and all next bars are really short of selling. So there are no real volumes. So the pivot point has been broken. There is a spike to the above the indicator, VSA horizontal line. We need to watch for the next bar. Next bar is red and it has a lower high. That's when we enter. Or we can enter immediately upon, that is the earliest entry, upon the printing of that volume spike above this horizontal line on the chart. As you can see, all previous bars were just short of this 57.21 level. Just short of that. And there is news. We can see a big spike above this level. We need to see what news was, and if our common sense is giving us cues that there is really good for that particular pair, then we have another confirmation that this was a really false spike, and then we can go long immediately upon the close of this candle. And then, as we can see, the price rally to the upside. So that is how we use volume spike strategy, guys. Support only exclusively on support and resistance levels. So is this clear to you? So we can move on to another theme. If it's all clear to you, I need to say, you guys, Google for it. This is introduction to volume spike strategy. There are a lot of material you can find around the net. So if you're interested, it can help you. Google it.
We have a question from John, regarding the time frame, if it matters, and which time frame would be optimal for monitoring volume spikes.
If we trade trends, then we go with the 4 hour and 1 hour, of course. If we want to see volume spikes on news-driven momentum, we can also watch for 1 hour, because usually we can see a spike 1 hour. These are all 1 hour candles. So usually when the news kicks in, we can see a big, for example, red candle sprinting out. So use it on 1 hour for news, and use it for 4 hour or for intraday, and 1 hour for intraday. But also you can check, because sometimes it depends on indicator. You can also go for indicator and try to see what does it tell you on news-driven momentum for 15-minute time frame. You can watch 15-minute time frame, and you can also trade 15-minute time frame. But usually I wait for the candle to close. If that candle is, for example, if news was at around 2:30, I wait for the whole 1 hour candle to close. But you can also try to spot it on 15 minutes. Don't go for 5 or 1 minute. Try 1 hour, try 15 for news-driven momentum, and for trend momentum, try to use 4 hour and 1 hour. Another question?
Not at the moment. let's
So
see.
that, no
That's
problem.
good, I guess.
So guys, just try to, if you want to test it, because there are a lot of indicators. Try to see what works the best. Put it on the chart and watch. For trend, it's okay. 1 hour and 4 hour, it's clear. It's clear. But for breakouts in news-driven momentum, use 15-minute time frame and see how it behaves, and watch it 1 hour and see how it behaves also. Because there are a lot of false movements into 1 hour time frame than, for example, in 15 minutes time frame. But you can use 15 minutes for scalping purposes.
Sounds good to me.
Yeah,
awesome
you can
stuff.
use it. Yeah, it can be really useful if you know how to use it. But you know, we are all now we are explaining different kind of strategies that can be found in Forex market, and there are a lot of traders who use different kind of strategies. So some traders prefer pure price action naked charts, some prefer indicator-based strategy systems, some prefer VSA range bars. So what I'm telling you is try to find your own preference. This is for educational purposes, and this kind of strategy can really work good in news trading environment.
Yeah, indeed, exactly. You have to find our own path. That's definitely good advice.
No.
Suits.
Market MT4 won't be different than in Alpari, because Alpari is also use liquidity providers on MT4. You may also find that candlesticks are different because of time zone difference. But that is why I prefer also Admiral markets, because we have London and London GMT +1 currently platform. So that is, for me, that is the most accurate platform. That is because it prints out basically London candlesticks, GMT +1. No. So it won't be different. You will just see spikes differently on your chart, but that doesn't mean that that is wrong. It doesn't mean that. So if you don't have any questions, we can move to another theme that is also important. Chris will present you swing trades.
Yeah.
So guys, let's find it
Exactly.
all over the internet. You can find a lot of material concerning this.
Awesome stuff. I'm definitely going to take a look at that. I mean, it's something that I've never really done, or maybe way in the past, a bit of research, but definitely not recently. So very interesting for me. Thanks for that. Going to take a look at that.
No problem.
On my own. I'm going to present you two types of swing trades I chose that I incorporate in my trading, and I have to admit that I do like swing trading. So this topic suits me fine, I guess. In that regard, of course, the two typical charts that would be used for any swing trading are usually 1 hour or 4 hour or 4 hour, maybe both as well. And what I typically look at is a combination of breakouts, Fibonacci trades, and oscillator. That was a bit typo there. And what I'm looking for is basically I can take a combination of that. We'll show you, though, a specific 4 hour trade and a 1 hour breakout trade. Okay. This is also the typical length that you could stay in a trade like that. I do concentrate a bit more usually on the 1 hour, but I think that you will see the benefit of this 4 hour trade as well, especially if you have a bit less time to monitor trades because you are at your job. And you can maybe only take a look at your lunch break, for example, or for whatever reason that you're not that active in a constant manner, looking at charts, up to date, very live. Then this is a good balance, maybe the 4 hour. Still has plenty of candlesticks within the week, 24. Of course, day candles only have 5, so that's substantial difference. No, 30, I should say, probably, actually. Yeah, 30 candles, excuse me. And day candles have 5, so there's definitely some more momentum and change with 4 hour. Then again, it's still quite a massive time frame. So what I look at for this 4 hour oscillator trade is strong. In the AO, by the way, is the awesome oscillator from Bill Williams, of course. And you can find that by going to indicators, Bill Williams, and then awesome oscillator, just in case. So what I want to see is a strong AO move in one direction or another, up or down. And what I want to see is then a retrace back to the zero line. And that gives me the opportunity then to enter on fib or breakout or candlestick pattern. So the setup is, for example, first of all, a trending mode. This is definitely a trending trade setup. And I want to see that trend confirmation. Then I want to see a pullback. And I define that pullback by a movement of the AO to the zero line. So not price, but the oscillator back to the zero line. And then that's the opportunity. And then I'm looking for a confirmation of actual entry or trigger, which I use these three techniques of fibs, breakouts, or candlesticks. So let's take a look at examples. This is a combination of the pound down and up move of recently, this year, March and April, February, March, April. And if it's a very strong trend, you will maybe only get a few setups in that entire trend because the oscillator just keeps on moving down and down in the downtrend or up and up and up in an uptrend. And you will not get a bigger retrace, and it just keeps on falling. For example, I'll give you an indication, like for example from here onwards to approximately here, you know, on this 4-hour chart, that would be the last entry. This would be just an ongoing move because it's the power to the downside is so powerful and just keeps on going. So it's not like you'll get 10 entries in a downtrend like this. This is the pound dollar downside, and I think there were maybe 5 or 6 of them. But still, you can see when it does happen, the currency has retraced significantly in this very nice downtrend, and it indicates that the retracement and pullback could be coming to an end, and it could be ready for yet another downside. And in this case, where I have my green arrow, it went for massive downside. Sometimes it goes down and you get a bit of a bigger pullback, as in the first case, right in here where I have a 1 and 0 and a circle around it, or in this case, still a nice downside, a bit less massive as the middle example. So what I'm looking for, first of all, is you can define the trend, for example, by using these moving averages. You can see this is 144 and a 34 EMA, prices underneath, and the AO right in here showing a nice peak to the downside or valley to the downside. And this is a retracement. Downside, retracement, downside, retracement, downside. All right? And you can see that price is all the time under these moving averages. No question about a downtrend. Now, I'll just go into how to enter. That's a bit later. I just want to look at the first two things, which is trend and pullback / opportunity. Then the third step will be looking at how to trade it, actually. Then we get a bit of a difference here. We get a push up that is definitely higher than these tops. Plus, we get a slow move down towards the zero line instead of a fast move down under the zero line. So that's the key difference here. And you see also price making a slow after an impulse. So there's the characteristics that show that the shift is happening differently than in these examples here. So that's the key difference, and you can see here that that's actually retracements for more upside. That's the key difference. All right. There's these AOs also work very nice for Elliott wave. We have a webinar actually already explaining the Elliott wave, so take a look at the archive. And I use Elliott wave. I use the AO also for Elliott waves. So take a look. If you like Elliott waves, not many probably do, but if you're the exception, then you can find the webinar there, and I use this AO as well for that. So the entries, first of all, fibs and breakouts. I'll just show you first breakouts. So you can use, for example, trend lines like I have here, red trend lines symbolizing the support line that we can draw on our chart, and a move under that line, and when also breaking maybe the support, if there's any support close by, would indicate the entry to the downside. And you can see that's one way of catching these AO turns upon the price breaking the trend line. That would be the signal that we're back in that downtrend. All right. So pretty nice, clean, impulsive breaks, almost in all examples, except here, where we had a sluggish move up, then a bigger retrace, and then we had more impulse. All right. Let's see another example. This is Fibonacci, and what I would be doing is taking the last swing high, swing low. In this case, you can see I didn't use this top. That's a bit tricky. That's actually one of those examples I used for support and resistance as well. That broke the resistance, but don't count necessarily on this being support. It has to do a bit with Elliott wave as well, but okay, that's maybe a bit tricky to explain here. But I fibbed this downside here. If you're in doubt, it's always maybe better to use a larger swing high, swing low than a smaller one. And if you want to know more about fibs, we also have actually a separate webinar on fibs in the video archive, so that's great stuff there too. And you can see that that's another way of trading it. If you fib the swing high, swing low here, and you get the retraces to 50, 382, 618, 886, deeper one, or 618, and here's actually double bottom. But still, stop loss held, and we got that upside to the 618 fib, as you can see, to the 618 fib, and here, and in here, and almost here, and in here, and in here. So those targets working very well, just like the retracements. By the way, yeah, you can see here also the moving averages pulling away in this uptrend when we get this bounce here. The last one then would be just our price action, and also that, of course, we've had already webinars on, bearish and bullish. So that's actually good that we have this webinar, I guess, right now, because all the key components needed to trade this have been already explained. So this seems to fit very well, actually. And for example, here you can see the AO. This was on the pound dollar again on the 4-hour chart, back to that zero line here, and bearish engulfing twins signaling that downside. All right. So that's one more way of trading that. Now, if we combine everything, and not saying necessarily that you should do that or must do that or even want to do that, because those are a lot of entries, unless you take extremely low risk, but maybe that would be possible, but otherwise it's too much. But just to give you the examples of possibilities that you could use just on this AO strategy, here you have the fib. That's not visible, but it is a fib from this downside. I think it's like 786 here. Then we have the engulfing bearish candle, so the entry would be right here on the formation, completion of that engulfing pattern, or the break of that bear flag, which is here, and the low, for example, or the break of this fractal right in here, or if you then fib this down move, you get a fib right in here. Or if you see the price action signal of this wick, you could take a chance even on that, for example. So a lot of opportunities. Just looking at a 4-hour chart, kind of funny because one would think maybe 4-hour charts, they mature, of course, slowly. That's why sometimes I lose sight of them as well, because I am so involved in 1-hour charts most of the time that looking at 15 currencies that sometimes I really forget, and it doesn't happen too often because the AO doesn't reach, it's not something that occasionally that happens every day. So sometimes I have to should keep an eye on it a bit more. So that's I'll answer your question in a second, okay, Rick? So that I lost my train of thought here. Yeah. So, but if you are, as I said, if you are looking for something that doesn't happen actually that regularly, or that you can monitor, I should say, while you are away, then this is a lot easier. And you can see that even with the 4-hour chart, you do have a lot of opportunities to trade as well, actually. So let me explain this slide, but before I do that, I'll just answer Rick's question. So regarding the trend change, so otherwise before I actually talk about this slide, let me go back a few slides and answer how Rick, regarding his trend change question. Trend change is is something you'll analyze, or I analyze, and what I do is just looking at 4-hour and day charts for, first of all, higher lows and higher highs, and lower lows and lower lows. If both the day and the 4-hour chart are in sync and in alignment with each other, then there's just a very strong trend going on. All right. If one, for example, there's a downtrend on the 4-hour chart and downtrend on the day chart, and the 4-hour chart is a wedge, that's still fine. But if the 4-hour chart is showing an uptrend, then those are not in sync. That wouldn't be too good. But let's see. Basically, moving averages show definitely a trend, or trend lines, stuff like that. Now, once, of course, at a certain point, the trend is going to end, and we can measure that by, as we know now, by volume, as T has explained, or by divergence on 4-hour day chart. Then we get an idea that maybe the downside is over. So, for example, here we can already see building divergence here, and the trend line that is showing some slant here. I mean, some bounces off here as well. So that's first of all volume and divergence. Then we can use trend lines like this, for example, to see if we break out of that downside like we do here. And also the power of the move is quite impulsive, and after that we get a corrective. So impulse, corrective nature also help in reading that. And also you can see the power of the AO going quite high. All right. So that's what you could use for your trend direction. Or you could use even the week chart and look at the candle. Just look at the candles. Are we having higher weekly highs and higher weekly lows, for example, or lower weekly lows and lower weekly lower weekly lows and lower weekly highs, for example. Okay, so those are all tools that you can use to establish the direction. Stop loss is always above the top or high in downside, and above low, below low or bottom, excuse me, below low or bottom for upside. The take profits, I'm using fib targets. See the fib webinar for that. So this is all stuff actually that you are well aware of now, hopefully, or otherwise you can take a look at that. And this is just, this is a very good for trending environment, not good for ranges. I think most cases. I like it for trends especially. So I'm going to show you one more example on the yen. This is just a small segment. Unfortunately, I couldn't really show the whole move because it was so it was so long. It took 6 months. Doesn't really fit on a 4-hour chart. But you can see how you can nicely capitalize every time this AO is back to the zero line on this 4-hour chart. You can see that that's a beautiful opportunity, and the purple line indicating the trend, a trend line and price most of the time breaking pretty impulsively out of it, except I think this one was a bit iffy here. So we could always draw a new trend line maybe. This one was a small break, but otherwise really a massive uptrend, and this is just part of it. I mean, take a look on your own chart for the rest of the trend. Looks pretty impressive. And the trend, I mean, the moving average is, of course, definitely showing that upside. And every time the price moves back to this moving average, basically, good opportunities there. All right. That's the dollar yen. So on the 4-hour chart. So let's take a look at the 1-hour break that I use as well. Let's see, but before we do that, Alessandro has a question about 8 pips breaking the higher low. That's a usual number that happens on 5 and 50-minute worlds. Not so much on 4-hour or 1-hour charts, but I did notice on the pound dollar that 8 is an often used number, and often when the higher low gets broken by 8 pips, that's at least a small resistance or support level. It doesn't necessarily mean an entire reversal, but it does cause often the currency to to retrace from there, but on smaller time frames. And then one more question in between. The indicator is Awesome Oscillator, and you can go to Indicators, Bill Williams, and then you find Awesome Oscillator. The 1-hour break is interesting. It's what I'm also looking for is a trend on the 4-hour and day chart, and then again a pullback on the 1-hour, and then a break of that trend line. So it's quite similar in concept. The conceptual idea is similar, but it's just on a 1-hour chart. But I'm still looking for a trend on the 4-hour and day chart. So as you can see, that's why I'm scanning a lot of currencies, and I'm looking just for a trending currency, not so much. Don't have to necessarily trade one particular currency. I like to look for a trending pair, and it's the same theory as the 4-hour chart to break, but you catch more breaks. For example, on the pound dollar when it was moving down a lot. Remember that segment when it was moving down a lot? Well, otherwise, let me just quickly go back. It's easier actually. When we were moving down here, on the 1-hour chart, you'll get a lot of breaks in between there. All right, so then the 1-hour breaks would be good, because when this is so impulsive, you won't get a 4-hour setup, but you will get 1-hour setups in here. That's what I'm talking about. So let's see. Let me go back now. So I want a trend, I want to pull back, and I want to break of that trend line. I'm entering upon the break of highs and lows, or fractal stop loss, opposite side, and the take profits, fibs, targets, or highs and lows. This is specifically a breakout strategy. If you're wondering how about the candlesticks and fibs, it's possible too, but I tend to look more for breakouts, because then I know that the momentum is back in play with the 1-hour chart. Sometimes you can get pretty big pullbacks, or if you fib the last move down on the 1-hour chart, it could be that that fib isn't really used that much. So, for example, here we have the dollar yen. I continued with the part of that 4-hour world. This is mid-January, beginning February. So let me go back to this yen. Sorry, I forgot already. All right, mid-January. Okay, mid-January. So mid-January is here. So from here to there, this is the 1-hour view. So on the AO, you can see we have entries here and here, but within that piece, not much, or nothing, I should say. So, but on the 1-hour chart, you can see these are the 4-hour entries as well. But on the 1-hour chart, we would have some entries besides these here, and I'll make the 4-hour entries. I'll make the 1-hour entries pink. Here you can see a nice trend line. Here you can see a nice trend line. Here even, and here as well. So there are add-ons as well. So let me, okay, that was it. Okay, so before I finish, I do want to add one thing. You can see when we break this fractal, that's when it gets impulsive. So it's a small stop loss here. The conventional target would be a top, but that's not a really, I should draw it a bit straighter, something like that. It's not, it's a decent reward to risk, but the fib target would be a lot better here. Here too, all right, and you would have a decent there, although actually the hook back gives, no, sorry, forget it, scratch that. Not a big move here, but still decent, right? Still, I think 1.5 to 1 or 2 to 1 reward to risk. This breakout here as well, that went a lot further, didn't it? So you can scale out some profit in here, and if you scale out something more, if you divide your trade, I should say, in multiple parts, then sometimes you can catch bigger runs as well. All right, and here, let me show you here, entry here, stop loss here, not that, sorry, that was a mistake. Right, so every time the fractal break, basically, right? Well, that's what I'm trying to show to you. And stop loss opposite side. And take profits either at the conservative high or at the fib target. So that's just what I wanted to show you. Ah, that answers Stefan's question. Great. So let's see if I have any questions on this one. The success ratio on the 4-hour world is high. If you go for a 1-to-1, it's 80%. If you go for a 2-to-1, it's 60%. That's upon fractal breaks and using the opposite fractal as your stop loss. That statistic is specifically for fractal breaks, though, not on candlesticks. But I mean, we know the candlesticks are very nice, accurate information, and those will have good percentages as well, of course. But now I'm talking about fractal breaks on the 4-hour. That's 80% with the 1-to-1, 60% with the 2-to-1. But I think that actually can be optimized a lot better if fib targets would be used, to be honest. And the 1-hour with a 1-to-1, yeah. But sometimes there's going to be some mistakes maybe made with the trend definition, so there could be some slippage in implementation. But even if that were to decrease to 70 or 60, I mean above 60, you're above the threshold for sure, right? The breakout trades on the 1-hour chart, well, that's, let me see, that's pretty good as well. What would be the percentage? Let me think. Well, the reward normally is like 1.5 to 2-to-1. That's a bit. Let me think for a second. I don't have any statistics, to be honest, at the top of my head. I'm just thinking in my practical experience quickly to see if I can come up with a number. Well, last month was high, but that's maybe was a very good month as well. So I don't want to use that as the average or something like that. If you draw your trend lines well, let me say it this way, and you catch the actual breakout of that key fractal, it's also a pretty good percentage. I mean, I would say at least 60 should be definitely there, or 50, 60, because the reward to risk is definitely 1.5 to 2-to-1. So, but I don't have something on top of my head. I would have to look at my Excel sheets and calculate it. Let's see. Stefan is asking if I would recommend using fractal break entries only on longer time frames. No, I use it for actually I use the same strategy, but on a 50-minute world. Although I use the 1 hour, I use the 1 hour time frame for the trend line, but I also use the 50-minute world as a trigger chart, and then I go for, a first amount of pips basically, and then the stop loss is even smaller. But that's a bit more riskier because the 50-minute world could have a lot more fake outs, small moves up and then down. So that's. But I use then as well the 50-minute fractal. So I use fractals on that time frame as well. But it doesn't have to be only 4 hour chart. But of course, then again, I have to say that the 4 hour world has the importance of that level is of course more important. It's high. Day chart bottom has a major significance in the market, of course, for a longer period of time. Alrighty. Anything else? Maybe on the volume still that T could answer, I should say, or maybe I on swing. So now that we explained this, maybe we can actually look at that more thoroughly as well. Now that this is explained, I can refer to this webinar, and we can look at that a bit more intense on Tuesday the 18th, I think, of June. Is that next week? Yeah, it is. Tuesday, 18th of June, we'll be looking at the charts live again, so we can look at this now that we have this knowledge. That's Tuesdays, Wednesdays, and Thursdays, 7:45 UK time. Alrighty, I think everything looks clear. What do you think, T?
Yeah, everything looks clear. Also, we will teach you how to use stop losses on the next webinar. So feel free to sign in and register for webinar. You will be surprised how stop losses are working good in nowadays trending trading environment.
Oh yeah, that's a good heads up actually. Regarding stop losses, we already talked about fibs and all that, but stop losses definitely going to be a good webinar. That's the next week?
Yeah, next week.
Cool.
That is on 20th of June. So in 7 days.
Awesome. Same time, same place?
Same time, same place, yes. I'm very glad, guys, that you attended this webinar. I also now looked around cable price action, and I see that cable jumped. It was stomp hunt 57.35. So that is when VSA can kick in and save you from from wrong trade. So feel free to practice and to Google for volume spread analysis.
Alrighty, sounds good to me.
Yeah, so to me too. So have a good weekend and have a handful of pips, green pips of course, and see you in 7 days, guys.
Exactly. Have a great weekend and cheers.
Cheers.
The organizer has ended the session.